we're going to be talking to you about sort of the tax and R&D related things to think about as you scale your business. Again, using the sort of curation of issues that we've been able to do by virtue of the vantage point that we have. We've distilled that to 4 or 5 points that we know to be typically the things that founders struggle with as they scale, the risks that we see founders run into, the challenges that we see them run into, so that we can relay them by way of this webinar, and then you are armed with that knowledge. So as and when it feels like you might be facing similar challenges, we're here to help. James, Jack, would you like to say anything before I get into the content?
No, it's great intro. Thank you so much. I was just going to say one further thing where we can add a little bit more kind of support is quite often my team specifically are brought in to look at diligence events for either VCs or for later stage tech companies, right? So quite often we're engaged by companies as they're looking at strategic investments or acquisitions, generally around Series A, B, probably Series C, right? And therefore, what we can do in some of the areas that we'll look at today are looking through that lens, like how are we reviewing, what are we considering when we're doing diligence on behalf of those VCs or those later stage tech companies. So again, using that as a really kind of hopefully insightful kind of experiences of what we see day to day, why we're seeing some of those issues, and hopefully we can basically say, look, these are the issues we're seeing, and actually give a little bit of thought leadership as to why we're seeing those issues surfacing again and again. So common themes that we're seeing during diligence events, and therefore hopefully for the people that are attending or listening to this, there are areas that they can then avoid at a later stage. So that's the angle that I'm going to come at it from, and hopefully therefore share some of those experiences so that you guys don't experience some of those same pain points that other companies face.
Brilliant. Okay, good stuff. I should say, as a bit of housekeeping, maybe should have mentioned it a bit earlier, that we are recording this session. So I should just make everybody aware of that. Hopefully it will be helpful for anyone that wasn't able to join today, but in case anybody does have any concerns around that, then please just let us know. But yeah, I should just mention that we are recording today's session. Right, okay, well, I'll get straight into the first topic that we wanted to cover today, and James, you kind of alluded to it already, but we wanted to talk a little bit around how companies can get themselves fundraising ready, particularly from the perspective of what we know VCs are looking for or looking at the moment. And so just in your sort of very unique style, it'd be helpful for everybody on this call to understand a little bit about not only from the perspective of, just generally fundraising materials, a deck, and a model and all of those sorts of things, but specifically risks that we know that companies should be managing ahead of a fundraising event.
Yeah, no, that's okay. It's a really good question. And just to kind of where this information has come from is recently, and well, all the time I'm discussing and having current updates with a number of the VCs specifically targeting kind of late seed stage businesses that are looking to write that first Series A or their Series B checks. And actually just to share some of that knowledge at the moment in terms of what we're seeing in the current market in and around some of their behaviors, because I think that's quite important in terms of companies looking at and looking to kind of potentially take on that first substantial VC investment check. Now, also we should also look at some of the negative behaviors that we've seen as well over the last kind of 18 to 24 months as well, and I'll come on to those as well. I think talking to some of the VCs over the past 3 to 6 months, what we're seeing is a lot more scrutiny, a lot more questioning of underlying information. They obviously have funds available to them, but actually a lot of them, and well, I'd say across the board, all of them have made the same point, which is the level of detail, the scrutiny which they're kind of reviewing businesses at the moment has never been so intense, right? So they're looking at that in so much more detail, making sure that if they're going to write a check, actually they're looking at all different aspects. Now, I'm looking at it through the lens of tax reviews and tax due diligence, but if we ignore that for the minute, they're looking and scrutinizing the future forecasts, the strength of balance sheets, the revenue models, and where they're going to identify those in so much detail, right? And unfortunately, gone are the days at the moment where actually just making those strategic investments off gut feelings has very much fallen by the wayside. So be aware they're going to scrutinize numbers, they're going to look, they're going to review, they're going to do detailed due diligence across the board. And again, we're aware that they're just fundamentally turning down opportunities, or their opportunities, because of that level of scrutiny. Now, what that's led to, and unfortunately what I've seen a lot of, is because there's been a slowdown with VC investments at the moment, it's given greater opportunities for later stage tech companies potentially to come in and to look at either acquiring or investing into businesses. Okay, so we have a situation at the moment where we've got tech companies who are looking to scale and grow their business. And because of the fact that they've obviously got a certain amount of churn on a monthly basis, they're looking for wider injections into their business. What we're seeing then is obviously those tech companies turning around and saying, well, look, we need to go and raise funding, and they're going to the banks and they're finding difficulty necessarily raising the funding from the banks. And therefore, what we're seeing at the moment is quite a lot of those companies actually going to or looking for acquisitions from later stage tech companies. I think there's been some interesting behaviours as a result of this, just to kind of flag and make people aware of. So what we've seen is multiple tech companies, and this is where I've been engaged, where we're looking at and considering the kind of the impact of these later stage tech companies investing or buying into businesses. And just be aware that what we've seen in the past is certain instances where businesses are slowing down their diligence because they're aware of the position. And then there's been a flip at the last minute where they've been super aggressive in terms of pricing, or actually potentially pulling out of the transaction as well, when they full well know the position of the earlier stage business. And I think, yeah, there's been quite a lot of instances, unfortunately, where basically, as part of the diligence, you are fundamentally showing your hand, you are showing exactly the position in good faith. And therefore, as a result, there have been instances where obviously companies are knowing of that position.
Yeah, and that's really interesting because I know obviously you do a lot of diligence on behalf of VCs as well, right? And so would you suggest that as a result of what you're being tasked with by those VCs, that some of these concerns are now actually coming to the earlier stages of funding, whereas sometimes historically this was the sort of diligence that would only happen at later stage funding rounds?
I think the honest answer here is that different VCs take a different view. If I'm being very honest, a lot of the stuff that we were doing at Series A was probably quite light touch previously. And really, like, it was so we would have very much designed scopes for Series A investments. And as I said, it would be, it wouldn't be scrutinizing things in huge amounts of detail. Fundamentally, what it would be doing is just ensuring that the company hadn't really done anything that was deemed to be kind of negligent. I think what we've seen recently is companies or VCs actually doing much more detailed due diligence, just to basically make sure there's no areas where there's uncertainty on their potential investment.
So if I'm a sort of seed stage Series A business right now, if you had to give a sort of top 3, top 5 things to think about from a tax perspective right now, just so that there are things that people can take away from this specific point, what would you say are the key points to remember?
Okay, so I think the main areas which are being scrutinized at the moment, I would say, and in no particular order, would be international exposure, right? So to what extent are there international aspects that hadn't been considered by the companies that was scaling and growing? There are an abundance of different areas where that can be looked at, and maybe we can touch on that in a little bit more detail. So I put international as number 1. I'd put R&D number 2, and Jack, you can talk to that. But what we're seeing at the moment is, unfortunately, huge numbers of HMRC inquiries and far higher levels of scrutiny attaching to businesses on their R&D, their historical R&D, but also future projections on their R&D as well. So that is coming. That is definitely coming up a lot more. Unfortunately, and I can give some light to this, we had a number of transactions that fell over last year by virtue of the R&D alone. And then I think the third area that I would consider is share options. And I think if we look at each of those areas, there's a bit of a common theme across all three of them, which we can explore in a bit more detail as we as we go through the session.
Brilliant. Okay, and so just to finish on some of the points around specifically leading up to a fundraising event and being prepared, Jack, it might be helpful from your perspective to just talk a little bit about, maybe one key takeaway from an R&D perspective that comes up in diligence, which can you can then take forward to then maybe talk a little bit around the R&D landscape more generally.
Yeah, absolutely, Asif, and I think the VCs are taking the same view that we're now seeing from HMRC, in that, is there an argument for what the claimant company, or for what the startup that's under due diligence has posited as R&D for tax purposes? Is there a risk that HMRC is going to swoop in potentially, not when they make the claim, but potentially 12 months down the line? They've received that cash, they've spent that cash. Are they going to turn around and ask that business, is what you're doing R&D for tax purposes? And we can touch on a bit more about this kind of arguments we're seeing coming back on that front. But should the company not be able to defend their position, is that HMRC going to seek to claw back that cash and charge penalties on it?
And you're finding that's coming up in diligence events, right? So the VCs are actually almost jumping on the mood of the hour, which is that HMRC have obviously upped the ante with their scrutiny, and so VCs want to be aware of whether that's something they need to account for in the due diligence process.
Yeah, absolutely. So VCs have always asked questions, similarly to previous approaches at HMRC around the numbers for the claim. Have you, thought about your SME status given the ownership of the business? Why have you claimed under this scheme and not that one? But now, we're seeing much more pushback from the technology-driven arguments for the claim, and ultimately what underpins the success of that claim as a whole, rather than more nuanced kind of points around the finances.
So we had that exact situation actually on a transaction. It was a little while ago. It's probably about 6-7 months ago. Actually, Jack, both of the areas that you talked about came up there. So actually, we started looking at a business, and the first thing that we challenged was actually the distinction between SME versus RDEC. We identified actually that they'd been claiming under SME, but actually, given the activity that was undertaken, actually their ownership structure should that have been under RDEC. And very just coincidentally, there was an inquiry raised at the same time by HMRC. Now, the other thing that came in as well was, and this is a major issue for businesses, HMRC then, and we started questioning the validity of the actual R&D that had been undertaken. So looking at the technological advancements, looking at the uncertainty, and really questioning in quite a lot of detail, actually scrutinizing whether they actually met the relevant criteria. Okay. Now, the issue that fundamentally was faced here was one that once we started discussing and exploring the situation, given the way that R&D works and the fact that it's so retrospective, they couldn't find the relevant people that were in the organization in order to start those conversations. Now, what that fundamentally meant was there was a complete lack of knowledge in terms of the periods in which we were inquiring into it, and they couldn't bring the people forward in order to try and find to basically to validate the R&D had been undertaken. So all you fundamentally had was a written report that had been submitted to HMRC that said we're doing R&D. Right? We started questioning it, and at the same time HMRC started questioning it as well, saying, well, prove to us, demonstrate to us the validity of your R&D. And the issue that fundamentally was faced was actually there wasn't enough substance. There was not enough in the way of people within the organization that could confirm that position.
Yeah.
What happened on that? And what happened on that transaction was basically, because HMRC were inquiring into the SME versus the RDEC status, and then they basically said, actually, and this is the approach that HMRC are taking with inquiries at the moment, we are questioning actually whether there's any R&D at all. Like in the past, they used to kind of say, look, let's find the middle ground and work out what's R&D, what's not R&D. They just said, we don't think there's R&D here. Fact. So the point from a diligence perspective is, we were concerned that actually they wouldn't even open up the 2 years, but given the severity of the situation, they could go back as far as 7 years. So actually, once you collated that level of information, and if they can't go back 2 years and respond on a claim 2 years ago, there is no way they're going to be able to go back to years 3, 4, 5, 6, or 7, right?
Yeah.
So at that point, you know, it was a bit of a no-brainer, because the company that was looking at making the acquisition turned around and said, look, this is substantial amounts of money, and if we take not only the R&D but penalties and interest that could apply on top of that, we're out, right?
Yeah. And so I think that, just to finish on the point around, I suppose, takeaways for people to be able to go into a fundraising process with, on the R&D thread, it's that if you are not confident around what has been submitted historically, or if you've used a sort of arm's length platform that to submit your R&D, which means that you went through a sort of algorithmic process of filing a return, and yet have been lucky enough to not been inquired into by HMRC, that you should probably seek to maybe either get a second opinion or clue up as to what your claims have said in the past, so that you're in a position to actually respond to those questions from the VCs when they come, because they will come, given the nature of the current circumstances around R&D.
I've got a slightly different approach and a different view.
Yeah.
Right. I think the R&D market has historically relied on looking at historical data to evaluate whether there's R&D.
Yeah.
Right. And Jack, myself, and the R&D team within Tech and High Growth have been thinking about this slightly differently. Let's flip this around. Let's flip this on its head in its entirety, right?
Yep.
Let's take a position where actually, so what we've got is everyone at the moment in the R&D space is being reactionary, right? And I always use reactionary as a really dirty word, okay? It means that, so look, so let's just say so most people will go, look, I'm preparing my accounts for, I don't know, December 22, as an example. The accounts have to go in, and as a result, I'm gonna have to do my R&D, okay? Now, what I'm then looking at is, what did I do from an R&D perspective between the 1st of January 22 and 31st December 22, right? If we're doing this now, that's 10 months ago from the end of the accounting period, right?
Yeah.
Right? It's actually, 20-ish months from the beginning of that period, right?
Yeah.
There's going to be a loss of data, loss of information across the board, like even if we're looking at it then. Right. So my view is actually that's not great. Now, we've seen people shifting to in-year claims, and what we're doing at the moment is we're doing a lot more of kind of support. So we're looking at companies and helping companies at the moment that are doing December 23 years. Now, most people don't generally do that. But actually, one of the things that we're talking about at the moment, and what we're doing with some clients as we're onboarding them, right, is actually, why are we not talking about December 24?
Yeah.
Hold up. What, James, what are you talking about? You're talking about a period that hasn't even started yet. Yeah, 100%. We know there are more inquiries than there have ever been in terms of R&D from HMRC. I say it's to all of my clients, I don't care about HMRC inquiries, and there's a reason for that. HMRC would inquire in 1 in 10 businesses at the moment. Yeah. Every single of my clients, yours clients, Jack, yours, Steve, they are going to be scrutinized. They're going to be reviewed, right? So we don't care about a 1 in 10 ratio. Every single one of our clients will be looked at, because all of our clients are VC-backed scaling tech companies, right? Yeah. And therefore we hold, and the quality by which we have to provide robust claims has to be much higher, right? We're not in the market of a quick buck to just kind of it's not a volume play for us, which I think is where, if we look at what's going on in terms of the kind of let's call them the boutiques, that's kind of what their angle is, right? At the end of the day, they can get inquiries, and if they're on a contingent fee basis, what they do is a volume play. And we know that's position. And that's partly why we're in this issue at the moment, right? And I'm not going to get we're not going to go down that rabbit hole of me debating why there are more inquiries at the moment, but it's fundamentally down to the fact that volume play, contingent fees, they will chuck anything in, right?
Yeah.
So what if we're in a position where we could start to talk to our clients more about what they're going to be doing and what they've got budgeted for the next financial year? If we can start getting to that position, and they start telling us about what projects they've got in the pipeline, and we can then sit with them and say, actually, that does feel like R&D, that doesn't, and we can evaluate that on a risk profile between, yes, this is R&D, this is a middle ground, and this is not, before they even started the work. And actually, they might then be in a position where if they are in that, and they could tweak the scope such that they're in a position where in the future they can actually adapt the work they're going to be doing so it does meet the R&D criteria, that's a really strong position, because you can almost take comfort then. You could take comfort on the fact that HMRC will finance that R&D, and therefore actually you can walk away from it. So it's kind of like, we never liked this whole advanced assurance because no one really signed up to it, but it's almost getting your head into that mindset where I can basically speak to an advisor that's really working with me about that future projection.
So yeah, looking at it more like a prospective, ongoing thing as opposed to a look back when your accounts are ready.
Yeah. And the other thing
that's really driven around the conversations we're having with founders, where the number one concern that they're raising over R&D is that certainty aspect. How can I include this in my cash flow projections? Is that credit going to come in that 40-day processing window, or am I going to have a compliance check and it's going to come in 6 months later?
Yeah, so that's a really good point, that, Jack. So I won't hold you to your answer, but it'd be an interesting point to touch upon is to what is your recommendation to founders insofar as forecasting cash flow or inflows from R&D? Because naturally with seed stage businesses, the elephant in the room is that the legislation suggests that you can't be reliant upon the R&D funds if you're in a position to claim in the first place. However, everybody knows that they are in some way reliant on the R&D funds, and so historically it's been kind of okay to say somewhere between 2 to 3 to 4 months max, maybe you'd be able to get your R&D claim credit in the bank. Now that has been completely blown out of the water. And so what would you advise founders from the perspective of forecasting inflows from R&D? And then latterly, if you wouldn't mind just touching on finishing the point around the inquiries, is that if people do receive an inquiry letter from HMRC, what would be your sort of proposed advice on how to act next?
Sure. So I think it's fair to say that the old way of doing things, of baking in an ever inflating R&D credit coming in at the same time every year into your cash flow, isn't the way to do things given the current environment, right? That's causing friction, like both intern, like from a general business perspective, in that your budget might have a hole of 100 grand, 200 grand, whatever that R&D credit might be in a year's time, as well as causing friction internally where CTOs in particular are under pressure from the finance and leadership arms of the business to make an R&D argument where potentially the work that they did, like you said, 12 or 18 months ago, doesn't fully support that position. Now, this is why we're recommending look forward, have some by all means make that assumption, but have some sort of underlying basis to back up that receivable in your cash flow, right? Have those honest conversations internally with your team, or in the case that you want some external advice around that, bring that in at the earliest possible juncture, when you're planning your roadmap for product development. Have those honest conversations about how much we're planning to spend here, what's the R&D intensity of that project. Could we potentially shift resources if we've got two work streams that we could be working on, and one is more likely to attract R&D relief from HMRC? Do we rebalance our development team and what they're working on, all things being equal? Now, as James has touched on, inquiry rates are much higher. So historically, we'd be looking at something around 1 in 100 claims being subject to some form of formal inquiry process. And as James has said, that's now more around the 1 in 10 mark, right? So we're an order of magnitude of scrutiny higher. So at some point, you can be reasonably assured that this is going to happen. Now, when that does happen, I guess the first thing to say is don't panic, right? You're not the only business in this boat. Burying your head in the sand is not the approach to take, right? Respond to HMRC. Generally, you'll be given around 4 weeks to answer their questions once you've received that initial notice of inquiry. Now, HMRC are generally quite amenable to agreeing extensions to that deadline, provided that there are, you have a reason, like key personnel are on holiday or we're in the early stages of a funding round, and the business resource to respond to those questions just isn't there. So being pragmatic about what's a realistic timeline to furnish responses to those questions, and planning internally, bringing that resource together of hopefully people who are there at the time. But of course, with the forward planning, part of that would also come into not just thinking about what we're doing in the future, what are we doing right now? Can we take notes contemporaneously as we're doing the work, such that should a key developer move on, that we have that information, it's not lost by the business, it's stored somewhere. So that should a need to answer those questions come, that information's at hand. Yes. Now, a lot of the initial questions that come from HMRC on these inquiries are generally quite pro forma. It'll be interesting to see if that shifts now that they have this online portal where the evidence for the R&D application is now very standardized, whether they'll raise more specific questions. But in general, the questions they are asking on the current list of inquiries tend to be fairly standard template format, but familiarize yourself with what they're asking for. So we know that the main focus of inquiries currently is, we don't think what you're doing is R&D for tax purposes, right? Focused on that technological gap between what was possible at the time that you started the project and what you were aiming to achieve. Why couldn't the current level of available technology support what you were trying to do? And where companies are getting mired in kind of lengthy processes here is where they are seeing, the product they've built, or the great features they've delivered, the great experience they're providing to their users, and they're trying to get that across to HMRC, but there's a mismatch there between what HMRC wants to see, which is, how have you built those features? What's the implementation that underpins them? What tools and existing processes and best practices have you used to construct them? Why weren't those existing tools enough for what you wanted to do? So really making sure that you've got a handle when you're constructing that response on that you're aiming it in the right direction. And I guess thirdly, coming back to what we've talked about personnel loss and attrition, asking yourself at the outset, objectively, how much of that information that's being asked of you can you supply, and being open and transparent about that without completely dropping your trousers on it.
Yeah, that's really no, I think that's really helpful. I think that the framing that I like to use when speaking to clients is that inquiry is almost the wrong word to use for what HMRC are doing with R&D, because it makes it sound a bit like an inquiry into VAT or an inquiry into corporation tax, the way that people will have been used to interacting with HMRC in the past. That, oh, okay, there's just a few innocuous questions to which I'll give a few innocuous answers and it will be fine. The R&D inquiry is actually more of an accusation, right? That what we believe you've done is incorrect until proven otherwise. And so the reason I try and distinguish between those two is because I think that the muscle memory people have of previous inquiries with HMRC has in some cases led them to believe that they can respond to these letters themselves, and that actually it's just a few basic questions that, once responded to, will make this disappear. And we've had this with people mid-acquisition, we've had this with people mid-due diligence, only to then find that HMRC will take the very first opportunity to say, okay, agreed, no R&D, can we have our money back, please? As well as penalties, as well as interest. And suddenly, at that point, the founder then feels compelled to seek advice, whether it's from us or from otherwise, to say, can you help, please? This feels like it's getting out of hand. At which point, on a few occasions, we've had to say, it's not out of hand, it's over. And that's really the distinction. I know, James, you wanted to say something, but I just wanted to make that distinguish between those two realities.
No, it's just to emphasize one of the points that you're making. It's so important that just by virtue of the fact that HMRC have paid out a check does not mean you're in the clear at all, right? Yeah. And what we've seen quite often is that HMRC will pay out the money, then they'll raise an inquiry at a later stage. So a question I get asked quite often is fundamentally, what should I do with that money? Is that money good to spend? Right?
Mm.
And the only answer to that is it's as good as the you can spend that money as long as the validity of your R&D is good, right? So what you submitted, if you're questioning that, if you're uncertain about that in any way, shape or form, then actually the position that you will find yourself in, the position you'll find yourself in is fundamentally, how long do you hold that money on account for, right?
Yeah.
And that's a really challenged position to be in. I think, and you know, that is, unfortunately, we don't have an immediate answer to that question. The other thing, as you said, just to reinforce another of the points that you made there, is unfortunately we had a situation recently where we were brought in to support a company that had received an inquiry. Now, this was a very late stage tech company. We know there are definitely areas at the moment which are being scrutinized. So software businesses, e-commerce businesses are again being scrutinized in a lot of detail. The position that ended up happening was the company had actually made their own R&D submission. We were then brought in to support as the inquiry started to kick off and support it. And fundamentally, there was a position that arose where, you know, the severity of the penalties got so high that the company in the end kind of defaulted. They said, look, we can't take the risk. We can't find the people to justify it. Now, that's such a normal position that we're finding. Can't find the people to support the R&D. We don't feel we've got the comfort. We don't think we did anything wrong. Let's just be really clear here. Like, the company has done absolutely nothing wrong when they've made that. Well, when either they've made that submission themselves or they've relied on a third party. That's almost the inference that, you know, that they are culpable for this. Actually, I think, you know, a misunderstanding of the facts isn't correct, but that's, you know, and that's the position that we see more often than not. And so Jack, that's the skill that you have. It's understanding the R&D legislation and then articulating that in a way to HMRC that makes it a slam dunk.
Yeah.
Right.
Yeah.
Now,
Absolutely.
I've given this example in the past. I don't touch R&D. As a tax partner, I don't touch R&D. I would never write an R&D narrative because I'm bloody useless at it, right? That's where, and how can I benchmark what R&D would be against other industry parameters? How would I know about technological uncertainty? I can't benchmark anything, let alone can I tell if someone's actually a competent professional in the field, which is why Jack and the other R&D providers, I'm relying on you guys, passing across to you guys in order to do that. So I think there are concerns when you are doing it in-house, but also I think using the right provider. Actually, there's no reason why companies shouldn't be doing diligence on the right providers and actually seeing, are they, you know, ask the question, how many inquiries have you got open at the moment? You know, do you have experience of kind of similar businesses to us? I'm just conscious of time.
I know. I was going to say that, I mean, a lot of this and so much of what we cover today is just wrapped up in the fact that there's so much bad information out there for founders. And, you know, James, you'll know that that's why you, me, other guys in the senior team at CP spend so much time trying to do ecosystem outreach, is just to try and make sure that all of the people that we work with, interact with, are on the right side of the right information. And I feel like R&D, unfortunately, is one of those areas that the market fell through the cracks a little bit because of the habits that HMRC ensued by virtue of paying money out and then not inquiring. And then when they did start inquiring, they started inquiring a lot.
I think your internet may have died.
Yeah, so we've lost Asif a bit there, but I think, yeah, it comes down to something we were talking about the other day, James, about the productization of areas of tax and being able to do things on the cheap through a, you know, usually a web-enabled platform that has very limited advice around it and doesn't capture all the nuances that perhaps, you know, speaking to someone with the knowledge in that space might have.
100%. So I totally get it, right? A scaling tech company doesn't want to utilize all of its resources or use some of its resources to pay for things when they fundamentally don't have to, right? There's always going to be that natural tension, that juxtaposition that sits between, I'm an early stage company, what is the easiest and cheapest way for me to resolve this issue? the point we're making here, right, and I hope I'm not coming across as a salesperson, is that fundamentally there are times when you do need to kind of start to think about the level of investment that you're making, because unfortunately a platform will only get you so far in terms of being able to support and the guidance that you need. The other thing is that a platform will not help you get out of a sticky situation when the shit hits the fan, fundamentally. And that's unfortunately what we've seen quite often.
Yeah, sorry about that. I think my internet may have spasmed a little bit, but hopefully I'm back in the room now.
Yeah.
But no, another just to move on a little bit, because what I was saying was founders just not having the right information at the right time, and R&D being one casualty of that. Another casualty of that we see a lot of, and James, you see the most of, is around international expansion and growing a global workforce, and how founders are just not, frankly, because the only place that they would realistically think to get information around these risks are from some of those EOR platforms.
Yeah.
But they're not in any way really incentivized to warn founders around some of the risks. And so it'd be great to just understand your perspective on how, when companies are using overseas contractors or having presence in overseas territories, what sort of risks that can land them in from a tax perspective.
Yeah, I've spoken quite overtly about my view on EORs, right? And there's a, if anyone wants to see, there's a really good article I say it's a really good article. There's an article that I wrote. Yeah. You could take your own view if it's good or not, called Eyes Wide Shut. You can look it up on LinkedIn, that I published a while back. Definitively, I do not have an issue with EORs. I think EORs are absolutely brilliant for companies that want to expand and grow at pace, right? And bring in resource, and actually to hire people effectively. The issue I have is that certain EOR providers do not kind of make businesses aware, tech companies aware of some of the risks that they create. And actually, again, back to the point and the reason for this chat today is you don't generally start to see those until someone starts shining a spotlight on the business. And that's generally when there's a kind of Series A, Series B, series fundraise, and someone's doing diligence, someone like me is doing the diligence. So just to kind of give you that kind of like that area of concern. So with EORs, so let's just say you're setting up, you're going to grow your operations, you're thinking about making some strategic hires overseas, or alternatively, you're allowing your workforce to work overseas and relaxing that they need to work in the UK, right? We see both of those instances. EOR is a great way of doing that. But you need to be aware that if you are going to allow, you're going to hire people on a global basis or allow people to work overseas for extended periods of time, there can be instances where you are creating a taxable presence in that overseas country or jurisdiction, which therefore might lead to the requirement to have a local filing in that country. Now, being honest, there are going to be situations where if this has happened during a diligence event, it's not going to make a deal fall over. It definitively isn't, right? But this is the kind of stuff when we know that companies are being scrutinized in so much detail at the moment. If this has happened across the board and there is risk attached, so there's multiple instances where there are huge numbers of risk arising because you've hired huge numbers of team members and that's how you've operated the business. And I have seen that happen, right? Unfortunately, we have seen it happen on a number of diligence events where we're talking not just one or two people, but we're hiring teams of people through EORs. And as a result, we unfortunately are creating, we refer to it as permanent establishment, PE, taxable presence risks in multi-jurisdictions over an extended period of time, which will then heighten the level of risk. That's where this comes in, right? So just be aware that as you're using EORs specifically, and giving 3 examples where this is really prevalent, is if, for instance, you are hiring any salesperson in another jurisdiction who is able to negotiate and conclude contracts on behalf of the UK business, I don't even think we need to think about that. You have immediately created what I'd refer to as a PE or taxable presence in that jurisdiction. Okay. If you have a fixed place of business, so you've got an office location, even a co-working space for a period of time, general rule of thumb is in most countries, it's probably somewhere between 3 and 6 months, right? If you've got an office location, then as a result, then you're creating a fixed place of business. And again, to what extent should you be therefore creating and thinking about making a tax filing in that country? And then there's also what's considered a service PE as well. Now, this isn't always the case. It's more often the case that we're using this in, say, Malaysia and Philippines. So if you've got a dev team and you're basing your dev team out of those countries, then actually there may well be instances where, by virtue of creating a service PE, now that's the provision of services either externally or internally, you can create a taxable presence in those jurisdictions. So just be aware of those areas.
Yeah.
And again, maybe seek some guidance if that is the position, because again, that'll come back to bite on a future transaction.
I think so much of this sounds quite far off for a seed stage founder, but actually, given the backdrop of the funding environment, the last thing you want is to be able to give venture capitalists a reason to not invest. That's nothing to do with your business. So if it's a sort of fundamental compliance or tax failure, these are the sorts of things that you just want to have tied up, particularly when funding is tight, because, as we know, venture capitalists' risk tolerance is very low right now. And so these are the sorts of things that you'd want to tie up. And I suppose using that same thread then around the current funding environment and just how that's affecting companies that we're working with, it'd be interesting to just understand how share options have been impacted by a lack of attention in some cases, or leading into a funding round. What sort of situations you've seen with share options that founders could think about in the lead up to a fundraising event.
Yeah. Okay. So with share options, I think there's been a major shift of using. So if we go back a few years, there was a major shift or a question asked: should we be using lawyers? Should we be using accountants in order to do our EMI workflows and valuations and everything else? And then what we've seen over the last few years is the use of automated platforms in order to kind of start to do some of the valuation and the filing work, right? Now, my personal view is you really use the lawyers for doing the legal drafting elements. You didn't really use the lawyers in the past to do the valuation work, right? The reason for that is because they were taking what I considered always to be a relatively overly prudent approach in terms of the fundraise. And actually, there was quite a lot of different approaches taken by different law firms, even in the same law firms, different approaches taken. My view is really, to what extent can we drive down the lowest strike price or the value that we agree with HMRC within the boundaries that we've got. Now, the world has then moved on a little bit, and we now have these automated platforms, right? And I get it, and I understand fully why people use them. They are super cheap, right? But the issue that we face, and it comes across from an R&D, it comes across from an EMI, it comes across from an international, it comes across from every aspect we look at. Tech companies are far more complicated than any other businesses at the same point in their life trajectory than, say, a manufacturing business or a commerce business, right? They've got far more complexity around how they've raised funding, the pref stacks that sit within the organization, the fact that they're generating IP. All of these things play in and therefore have consequences in terms of how you think about valuing that business for a share option perspective, right? So the issue that I'm seeing is, generally speaking, the platforms there's a number of issues I have with the platforms. The first issue is the platform really look at a snapshot of information at the current time, right? They're not really evaluating the position based on historics or future positions. So a current example we've got at the moment is, actually, we've got a client that we're speaking to at the moment who used a platform, and because the platform didn't ask the right questions, right, because there was a lack of human interaction there, it seems like a really small point, but they turn around and these guys are doing a Series B at the moment, right? Now, they didn't ask about the timing of the Series B, and they basically based it on historical data. Now, the Series B is going to come in, and that's going to massively impact on the share price. So the share price that will agree with HMRC is fundamentally incorrect, right?
Yeah. And it's worth mentioning there, James, that even if you get an HMRC approval, it is predicated on the fact that you gave them all the relevant information at the point of doing the valuation. Yeah. So if you're not not being asked the right questions, you're not giving the right answers, you're getting therefore a phony approval from HMRC upon which you're basing your whole share option scheme. At the point of a due diligence event or an exit, HMRC have fully within their rights the ability to then query the previous applications you made for valuations and say, actually, that was fundamentally wrong because you didn't tell us the right things.
Yeah, and if it's wrong, let's just be honest here. So you put it in at par, but there was a fundraise 2 weeks later, which basically dictated that the price of an ordinary share, let's say, is £100. And we've had instances again where there have been secondary transactions which have been used to be able to peg what a market value of an ordinary share is. What you're basically saying is there is an imputed discount against the share option. So what you thought was EMI, well, it is still EMI, but because you've got you've got a perceived discount, actually a lot of that will be subject to PAY and NIC, right?
Yeah.
So I question what's going on with valuations at the moment. I just don't think, and also I don't think the platforms really take an approach that seems sensible, in my opinion. There is a pretty much prescriptive, well-trodden path. A lot of the platforms will just discount against the last fundraise, irrespective of when that was, or include like consideration around if there's pref stack in there and taking out the assets of the business, right? So that's my first point. I think there is still a use and requirement for human interaction here, because actually that really, you know, you can look at things differently. You can start to analyze. You can bring experiences, and again, like, you know, you want to be talking to advisors that are used to working with tech companies. The other thing that I've seen go wrong with the platforms, I'm hoping this is less of the case now, but when we were doing a lot of the diligences before, a lot of the platforms, you would do the valuation, right? You would then grant the options using the platform. And the issue that you then had was that there was no follow-on from anyone. And unfortunately, there are certain rules with EMI because it's so beneficial. So for instance, when we're doing diligence, EMI is so easy to go after, right? So all you do is you basically say, when was the valuation agreed, right? Let's have a look at the valuation. Look at the valuation and determine, actually, were there any other factors around that time that wasn't disclosed? So we'll look to see if there was an external third-party fundraise. We'll look if there's any secondaries. We'll look to see if there's any kind of CLNs, saves, ASA warrants, right? And see if there's anything else in there, right? Because those could have an impact on the valuation. If they weren't disclosed, as you said earlier, that piece of paper from HMRC isn't worth it. It isn't worthless, right? Then what we then do is HMRC will write back and say, look, you've got 60, 90, 120 days, depending on when that was submitted, to basically grant your options on the basis of the valuation as it stands at the moment. So all you need to do then is basically, when were the options granted? Was it within that window? If it wasn't, then actually they're not EMI.
Correct.
Okay? They're unapproved. They're unapproved options. Okay. So that's an interesting situation, because again, you can then argue, if you're doing a diligence at that point, you could argue that those options should never have been under EMI, and therefore the total delta on any growth should be subject to PAY and NIC. Okay.
Yeah.
And then the third point is you then need to notify from the date of grant. You've got 92 days in order to let HMRC know that you've granted the options, right? And this was the biggest problem that we had. We saw so many businesses that weren't doing that. And if once that 92-day mark is up and over, then you're not in a position, they're not EMI options unless you've notified HMRC. So again, we were seeing countless instances. And if you're doing a diligence, right, and I'm on behalf of the VC, right, generally, I'm quite a nice guy, okay? But if I'm acting on the behalf of the VC, my job is not to be a nice guy, right? And to actually pull apart and identify where those issues are. And unfortunately, we were seeing that come up again and again and again, because of the fact there's no human interaction, because it's a platform, because how do you do this for £1,000 a year? Well, the reason you do it for £1,000 a year is because you've got no or limited human interaction on these things.
Yeah.
Right.
Yeah. Cool. Okay. All right. Well, I think that's probably about as much tax as everyone is going to be able to digest in one go, but hopefully gives everybody at least a few things to think about in the lead up to a fundraising event. And I guess the main thing that the three of us would probably like to promote is the fact that we shouldn't be thinking about these things in light of a fundraising event. We should be thinking about them on a prospective basis so that they don't become a problem at a fundraising event. And so insofar as anybody that's watching or is on the call feels as though there's something that we've talked about today that, they'd like to discuss further, all of us here in the THG team are happy to respond to those. But other than that, anything else from you guys before we sign off?
No, nothing from me. Just to thank the guys who've attended for their time this afternoon.
Similarly, thanks a million.
All right. Okay. Well, Emily from our marketing team will have a recording of this, and I'm sure we'll share the details how people can obtain that. But for those of you who attended, thank you, and we hope to see you soon. Take care, everyone.